Ladies and gentlemen, what if the biggest move in the gold and silver market isn't coming from inflation, but from Washington? Reports and rumors are swirling about a possible Trump metals law that could reshape the precious metals landscape. At the same time, Jamie Dimon continues to warn about growing economic uncertainty. Are gold and silver investors about to face a major turning point or a once-in-a-generation opportunity? In this video, we'll separate facts from speculation, examine what could really happen, and discuss why every precious metals investor should be paying close attention. When discussions begin circulating about a potential change in metals policy, the first reaction in financial markets is almost always emotional. Investors rush to conclusions, headlines become more dramatic by the hour, and social media turns speculation into certainty within minutes. That's exactly why experienced precious metals investors approach these situations differently. They understand that rumors come and go, but policies, if they become reality, can reshape markets for years. The key is learning how to distinguish between noise and signals before everyone else catches on. History has shown that governments have always played a significant role in commodity markets. Whether through tariffs, mining regulations, strategic reserves, import restrictions, or taxation, political decisions have repeatedly influenced the supply and demand of precious metals. Markets don't simply react to economic data, they react to expectations. Sometimes the anticipation of policy changes moves prices long before any official action is taken. This is where many investors make their biggest mistake. They focus entirely on the headline instead of asking the more important question, what does this mean for the physical market? If you're only watching the daily price, you're missing most of the story. Gold and silver aren't just financial assets. They're tangible commodities with real-world supply chains, production costs, refining capacity, industrial demand, and investment demand. Any policy that affects one part of that chain can eventually ripple throughout the entire market. Suppose regulations encourage more domestic production of strategic minerals or alter trade relationships involving metals. The immediate impact may not even be visible in the spot price. Instead, it could appear first through changes in mining investment, refining capacity, transportation costs, or the availability of physical metal. These structural shifts often develop slowly before becoming obvious to the broader market. That's one reason seasoned investors pay close attention to physical supply rather than relying solely on paper market movements. The futures market can experience significant volatility in a single trading session, but the physical market often tells a different story. Dealer inventories, premiums, delivery times, and wholesale demand frequently provide clues that aren't immediately reflected in headline prices. Another factor worth considering is investor psychology. Financial markets dislike uncertainty more than almost anything else. Even the possibility of major regulatory changes can encourage institutions to adjust portfolios, hedge risks, or increase exposure to hard assets. These shifts may begin quietly well before retail investors notice them. By the time mainstream media declares a trend, much of the positioning has already occurred. Silver deserves particular attention because it occupies a unique position unlike almost any other commodity. It functions both as an industrial metal and as a monetary asset. During periods of economic uncertainty, investment demand can increase dramatically. At the same time, industrial demand from sectors such as electronics, renewable energy, medical technology, and advanced manufacturing continues to grow. When those two forces align, silver's price movements can become far more dramatic than many investors expect. Gold behaves differently. It has served as a store of value for thousands of years, surviving wars, currency failures, financial crises, and political transitions. Central banks continue holding substantial gold reserves for one simple reason: confidence. Gold carries no counterparty risk. It doesn't depend on the promise of another institution to maintain its value. That characteristic becomes increasingly important whenever uncertainty enters financial markets. It's also important to remember that markets often overreact in both directions. Rumors may temporarily push prices higher or lower without changing the long-term fundamentals. That's why disciplined investors avoid making decisions based solely on fear or excitement. Instead, they monitor supply trends, monetary policy, government debt levels, currency stability, interest rates, and industrial demand. These factors tend to have a much greater influence over long-term precious metals performance than short-term political headlines. One overlooked aspect is how institutions prepare during uncertain periods. Large financial firms rarely wait until every detail comes public. They continuously assess potential outcomes, rebalance risk, and position themselves for multiple scenarios. Individual investors should adopt a similar mindset, not by trying to predict every headline, but by building portfolios that remain resilient regardless of which scenario unfolds. Diversification remains one of the strongest tools available. Physical gold, physical silver, quality mining companies, royalty businesses, and other carefully selected assets each serve different purposes. No single investment solves every problem, but together they can provide balance during periods of heightened uncertainty. Another lesson repeated throughout financial history is that patience often outperforms emotion. Markets frequently experience sharp moves immediately after major news breaks, only to reverse once participants evaluate the actual implications. Investors who remain disciplined usually make better decisions than those chasing momentum driven by headlines alone. The most successful precious metals investors aren't necessarily the ones who predict every policy decision correctly. They're the ones who understand the underlying fundamentals and avoid being distracted by daily market noise. They recognize that wealth preservation is a long-term process, not a race to react first to every rumor circulating online. Ultimately, discussions about possible changes in metals policy should encourage investors to ask deeper questions rather than jump to conclusions. Is physical demand strengthening? Are mining companies increasing investment? Are central banks continuing to accumulate gold? Is industrial demand for silver expanding faster than supply? These are the questions that matter because they reveal the health of the market beyond the latest headline. In the end, successful investing in precious metals has always been about preparation rather than prediction. Policies may change, markets may fluctuate, and headlines will always come and go. But the fundamental principles remain remarkably consistent. Understand the physical market, focus on long-term trends, manage risk carefully, and never allow speculation to replace disciplined analysis. Those who approach precious metals with patience, education, and perspective are far more likely to benefit from whatever changes the future may bring. There are periods in financial history when the precious metals market simply drifts along, reacting to daily news, interest rate decisions, and short-term investor sentiment. Then there are periods when several powerful forces begin converging at the same time. Those are the moments that deserve attention because they often mark the beginning of much larger trends. Today, many of the conditions that have historically supported gold and silver are appearing simultaneously, and that's why experienced investors are watching the market more closely than ever. One of the biggest drivers is the growing amount of global debt. Governments, corporations, and consumers have accumulated debt at levels that would have been difficult to imagine just a few decades ago. Debt itself isn't necessarily a problem, but servicing that debt becomes increasingly challenging when borrowing costs remain elevated or economic growth slows. Throughout history, periods of excessive debt have often led policymakers toward measures designed to stimulate growth, stabilize financial systems, or maintain confidence. Those actions can have long-term implications for the purchasing power of currencies, and that's one reason precious metals continue to attract attention. Gold has always been viewed as financial insurance rather than simply another investment. People don't own it because they expect excitement every day. They own it because it has repeatedly demonstrated its ability to preserve purchasing power through changing economic cycles. It isn't dependent on corporate earnings, government promises, or the financial health of a single institution. That independence is exactly what gives it value during uncertain times. Silver shares many of those same characteristics, but it also has another powerful advantage. Unlike gold, silver plays a vital role in modern industry. It is essential in electronics, advanced medical equipment, renewable energy technologies, telecommunications, electric vehicles, and countless manufacturing processes. Every year, industries consume enormous quantities of silver that are difficult or impossible to replace with cheaper alternatives. This creates a unique situation where industrial demand and investment demand can rise at the same time. When investors begin seeking safe haven assets while industries continue consuming silver for manufacturing, the market can tighten much faster than many expect. Unlike paper assets, physical silver cannot be created with a computer keyboard. It must be discovered, mined, refined, transported, and delivered. Those processes require years of planning and billions of dollars in investment. Supply simply cannot respond overnight to a sudden increase in demand. Another important consideration is the declining quality of many mining deposits around the world. Producing precious metals today often requires processing significantly more rock than in previous decades to recover the same amount of metal. Higher production costs, stricter environmental standards, rising labor expenses, and lengthy permitting processes have all made it more difficult to bring new mines into operation. Even if prices rise substantially, increasing supply remains a slow and expensive process. At the same time, central banks continue demonstrating confidence in gold through their reserve management strategies. While individual investors often focus on daily price fluctuations, central banks tend to think in decades rather than days. Their decisions are generally based on preserving financial stability and maintaining confidence during periods of geopolitical and economic uncertainty. Continued accumulation of gold reserves signals that precious metals remain relevant within the global financial system. Inflation is another factor that deserves careful attention. Even when headline inflation moderates, the cumulative effect of higher prices continues to reduce purchasing power over time. Households experience this reality every day through housing costs, food prices, healthcare expenses, transportation, and utilities. Precious metals have historically served as one method of preserving purchasing power. When currencies gradually lose value through inflationary pressures, currency markets themselves also contribute to the outlook for precious metals. Confidence in any currency depends on fiscal discipline, economic strength, and responsible monetary management. Whenever questions emerge regarding long-term currency stability, investors often diversify into tangible assets that cannot be created in unlimited quantities. Gold and silver have fulfilled that role for centuries because their supply grows slowly and predictably. One characteristic that frequently surprises new investors is silver's tendency to lag before accelerating rapidly. During the early stages of precious metals bull markets, gold often attracts institutional attention first because of its monetary role and larger market size. Silver sometimes appears relatively quiet, causing many investors to lose patience. However, once momentum builds and investment demand expands, silver has historically demonstrated the ability to move much faster than gold over relatively short periods. Its smaller market size means that increased buying pressure can produce significant price movements. Market sentiment also plays an important role. There are times when investors become overly optimistic about financial assets and ignore precious metals altogether. Eventually, sentiment shifts. As uncertainty grows, attention gradually returns to assets that have demonstrated resilience across generations. These transitions rarely occur overnight. Instead, confidence changes slowly before becoming obvious to the broader public. Physical ownership remains another important consideration. Many investors focus exclusively on price charts without considering the importance of holding tangible assets directly. Physical bullion removes certain risks associated with financial intermediaries. While paper instruments may provide exposure to price movements, physical ownership offers a different form of security that many investors value during uncertain economic conditions. Discipline becomes especially important during critical phases. Markets rarely move in straight lines. Corrections, periods of consolidation, and temporary setbacks are normal components of every long-term trend. Investors who understand this are less likely to make emotional decisions based on short-term volatility. Instead, they remain focused on broader economic fundamentals rather than reacting to every daily headline. Perhaps the most important lesson is that precious metals should not be viewed solely through the lens of speculation. Their primary purpose has always been wealth preservation and risk management. Price appreciation can certainly occur, but their greatest value often emerges during periods when confidence in traditional financial assets begins to weaken. No one can predict the exact timing of future market movements. However, history consistently demonstrates that when rising debt, persistent inflation, constrained mine supply, increasing industrial demand, geopolitical uncertainty, and long-term concerns about currency purchasing power begin converging, the precious metals market deserves careful attention. These conditions do not guarantee immediate price increases, but they create an environment in which gold and silver become increasingly relevant to investors seeking stability. The investors who tend to benefit the most are rarely those chasing headlines or attempting to predict every short-term fluctuation. They are the ones who recognize long-term trends early, remain patient during periods of volatility, and understand that wealth preservation is measured over years rather than days. When viewed through that perspective, The current environment appears less like an ordinary market cycle and more like a period that could shape the precious metals landscape for many years to come. Financial markets have a way of rewarding confidence during calm periods and punishing complacency when conditions begin to change. That is why experienced investors pay close attention whenever respected leaders in the financial world express concerns about the economy. The value isn't in treating every warning as a prediction of disaster. Instead, it lies in understanding what those warnings reveal about the broader financial landscape and using them as a reason to evaluate risk rather than ignore it. The modern financial system is more interconnected than ever before. A problem in one sector rarely stays contained for long. Banking, government debt, corporate borrowing, global trade, currency markets, and commodity prices all influence one another. Because of this complexity, uncertainty can spread quickly, even when the original issue appears relatively isolated. Investors who recognize these connections are usually better prepared than those focused only on daily market headlines. One of the biggest challenges facing today's economy is the sheer amount of debt accumulated across governments, businesses, and households. Debt can stimulate growth when managed responsibly, but excessive borrowing eventually creates difficult choices. Higher interest costs consume larger portions of government budgets, businesses face increased financing expenses, and consumers become more cautious with spending. These pressures can slow economic activity while increasing financial uncertainty. Inflation remains another critical factor. Even if inflation slows from previous highs, the higher cost of living continues affecting households and businesses alike. Purchasing power gradually declines when prices rise faster than income over extended periods. Throughout history, periods of persistent inflation have encouraged investors to seek assets capable of preserving long-term value rather than relying entirely on cash or fixed income investments. Interest rates also deserve close attention. For many years, markets became accustomed to unusually low borrowing costs. Businesses expanded aggressively, governments borrowed heavily, and investors accepted greater risk in search of higher returns. As interest rates rise, that environment changes dramatically. Loans become more expensive, refinancing becomes more difficult, and highly leveraged sectors face increasing pressure. Markets must eventually adjust to this new reality. Gold has traditionally served as a form of financial insurance during uncertain periods. Unlike financial assets that depend upon corporate profitability or government obligations, physical gold exists outside those systems. It carries no credit risk and requires no promise from another institution to maintain its intrinsic value. That independence explains why it has remained relevant through centuries of economic cycles, political changes, and financial crises. Silver deserves equal attention because of its unique dual role. It functions as both a monetary metal and an essential industrial commodity. Modern technologies require significant amounts of silver for electronics, medical devices, renewable energy infrastructure, telecommunications, and advanced manufacturing. If industrial demand continues expanding while investment demand strengthens simultaneously, supply conditions could become increasingly tight over time. One mistake many investors make is assuming that diversification simply means owning many different financial assets. True diversification involves owning assets that respond differently under changing economic conditions. Stocks, bonds, cash, real estate, commodities, and precious metals each perform differently depending upon inflation, economic growth, interest rates, and market confidence. A well-balanced portfolio recognizes these differences instead of concentrating risk in one area. Another important lesson involves distinguishing between paper exposure and physical ownership. Financial products linked to precious metals can provide price exposure, but physical bullion offers a different form of security because it represents direct ownership of a tangible asset. Each approach has advantages depending upon an investor's objectives, but understanding the distinction becomes increasingly important during periods of heightened uncertainty. Preparation should never be confused with panic. Successful